So I think the probability of recession is increasing. Sounds like you think the same.
What do you think, roughly?
I think it's greater than 50-50 in the U.S. economy.
Over the next
for recession?
12 months?
Yeah.
24 months? How long?
I think it's greater than 50-50 over the next 12 months in the U.S. economy. My work is mainly focused on U.S.-centric data. So I have a two-part question to you is, what's your view on the probability of a U.S. recession, given your views on China? Because I know you've done a lot of work there. And given those views, how far do you think the Fed goes vis-a-vis their 3.5% peak rate right now? What's priced into the curve is 3.5% Fed funds rate by June or September of 2023. So what's your view on recession in terms of the risk that China poses?
Considering these headwinds, they're going to struggle to get there anyway, right? So
correct.
The question is,
so how far do they get?
I think $1.75 on Fed funds, but $1.75 to 2
is the farthest they get
by the end of this year.
Because your view on recession.
Yeah, I think the probability of recession is still very low, just given the labor market. However, like we're dealing with dynamics of, like you have so many employees. Like for example, today the ISM came out, right? Mm-hmm. Demand overall is still very strong, slowing for sure, but the employment component of ISM today almost went negative. It was 50.9. Mm-hmm.
Right.
How is it that we have two jobs for every one person unemployed, but the employment part of ISM is coming down so much? To me, it seems we're at the point where people are like, I can't afford these people anymore. I need to start cutting heads. Mm-hmm. So we could still be at full employment for a while, but the piece that the adjustment factor in this equation is people's consumption, which comes down pretty significantly.
We haven't achieved a final settlement of the new economic structure post-COVID. Mm-hmm. We're in an intermediate period now where you had pre-COVID, you had lockdown thing, and then you have now, and we're all discovering how permanent is this arrangement of whatever now is. Like there will be some amount of work from home and some amount of work from business place. There will be some people who mandate you to wear a mask when you come in and some people who no longer care. But it's not like it's gone away. COVID still exists. And people are kind of formulating, I think, like much longer term forecasts about what life looks like post or throughout this now. And there are certain businesses that might have held on that could come to a realization that.
I think on your point and to your point, this is one of the biggest factors that drive sort of forward asset returns and what the world looks like in 12 to 14 months is what China does with COVID. If China continues on their current sort of lockdown policy, it's a huge issue. Right now they have 40% of their economy locked down. China drives like half of global GDP growth. So if they're shutting down their full economy, we could just be in a recession from here through the end of the year on a global basis, just from China alone. From China. Then you add in the energy component in Europe. You add in sort of what's happened on the rate side here, the highest moving rates on a 6-month basis since 1987 on twos. I think when was the last time on mortgage rates? It was like 90. What did you say?
Like in the 80s, I think.
80s, something like in the 80s on mortgage rates. Like the moves you're seeing in rates, which ultimately drive forward growth, have been so severe that we're now setting ourselves up for a massive tightening and slowing that the Fed clearly, as they always do, acts at exactly the wrong time.
So I just think that the probability of recession is a little bit higher because the current growth rate, depending on how you want to measure it, right? Let's take out the negative 1.4% GDP and try and extrapolate where the economy's been over the last 6 months. Over the last 6 months in real terms, so excluding inflation, depending on what measure you use, we've been somewhere between 1% and 2% real growth. That tightening that you just mentioned, the FX vol that's been historic, which has transitioned to historic interest rate vol, is going to come through the economic data over the next 6 to 12 months. We still have 6 to 12 months of slowing to come based on what's happened with mortgage rates and
one point on
corporate
that,
rates.
In order for things to pick up, you probably need rates to go lower, and rates haven't even
exactly. We haven't even topped yet.
So
if we're already at 1 or 2 and we have 6 or 12 months of slowing to go, you better hope that that's a really mild slowdown that's coming. And you're basically betting on a mild slowdown that comes on a historic rate shock.
So like my point was basically like, I think there's been a tremendous amount of frictional stress on the economy caused by COVID that's been papered over by the Fed, the The last 2 years, the deficit to GDP was 15% and 13%. If you benchmark that to our average debt to GDP for the 5 years running previously, the overage is sort of, combine the overage and you get 21%. So we spent 21% of GDP in 2 years over our normal debt to GDP.
Right.
That can paper over a whole lot of frictional brain damage.
Right.
If that's no longer an option and the Fed is painted in, and now we're experiencing that frictional brain damage, which is businesses that have held on for as long as they could or have made the rational assessment that I have the money, but I'm not going to do it anymore. It's like not a good thing. I just don't think it'll make it,
Right.
There's the scope for, I think, the revelation of that without the option to address it.
Yeah. Do you want to talk about debt to GDP? I feel like you got a great stat on the top of your tongue now.
I was going to comment on what you said, which was we papered over a lot of problems using debt. But I think the part about using debt that people misunderstand is that it doesn't come without a cost, right?
Well, you know how much the Fed bought of that?
The Fed bought a significant amount, but I don't think
A third of it.
that's not free either, right?
No, it's monetization of the debt.
Right. So one of the things that we were talking about in before we started recording was whenever you look at these debt binges, let's say, or extreme amounts of government spending, you have to give 3 years for the full effect of the policy, right? Because if you borrow money and spend it, you're going to get an increase in growth right off the bat. There's no question about it. But then after that spurt of growth wears off, the debt is still there. So you need 3 years to establish what the full effect of a major debt binge has done to the economy or to growth. If you assume that the primary fiscal thrust came through towards the end of 2020 into 2021, and you give it a 3-year period, that would mean that we have to be somewhere in 2023 or 2024 to assess what the full impact of this policy has been. I think that a lot of us are assessing what the impact has been, only living through the upside of that sine curve. We're now just getting to basically, part 1.5 or year 1.5 of this 3-year window, and we're sliding down the backside of this curve right now, and it's starting to look pretty nasty. That's where this recession probability comes in.
What has goods consumption done?
The consumption of goods?
Yeah.
The consumption of housing and durable goods exploded during COVID. Prior to COVID, the economy was about 11% housing and durable goods. Even though it was a small segment of the economy, that's the cyclical engine. Housing and durable goods or housing and vehicles drives everything. That was 11% of the economy. In 1 year, we went from 11% to 14%. So we basically transitioned 3%.
Like how big of a standard deviation thing is that?
It was the largest 1-year change.
So it's basically 11%
like 3
always.
to 4, yeah.
No. So it was 14, 15% in the 1970s, right? And then it kind of came down, and then it went back to 14 or 15% pre-GFC when we were going crazy.
Yep.
And then there was a huge bust.
Okay, so pre-GFC, that's not a normal situation. The 70s, that's sort of a different time frame. And
in the 70s, we had a huge demographic tailwind that was driving that
the
housing.
baby boomers.
Exactly. So what we had now was we had the economy that was sitting at about 11% housing and durable goods as a percent of GDP. In 1 year, we took it to 14%. Not on the back of any organic demographic tailwind, on the back of a major binge in debt. So now we basically exploded.
I also think there was this huge, when COVID hit, I could count as many people as you want who made moves, like sold their homes and moved.
Right.
So,
but did they make that move because of a fiscal stimulus check, or it was a total behavioral move?
It was. If you look at the prices of homes in places that used to be considered sort of crappy, there was a pretty good size adjustment in prices.
Right.
Because there's a pricing of, this thing's going to last for longer than I expect.
Right.
I could work from home or move here. And then there was also a second thing, which was to move away from places that have if there's going to be a ton of debt, to move away from places that have a high tax rate.
Right.
And so if you put together
the financing piece too. The Fed buying every mortgage bond available.
Right.
Yeah, so you put together these two things, I'm like, okay.
The point that I'm trying to hit on is what you're saying is that everything that you're describing, I fully agree with, but these are one-time bursts of demand.
Yeah, agreed.
These
I was just asking.
Yeah.
I was thinking
So-
about like what.
So when we went from 11% to 14% in 1 year, the largest 1 year change ever, we shifted 3% of our economy to the cyclical part, and that totally, and that's the part that needs supply chains. That's the part that you manufacture. It's not like going to a movie theater. So if we got there on the back of what is very clearly a one-time demand in stimulus, a one-time demand in a behavioral change, what's going to happen now that that move has already happened? Now, I'm not saying that we go from 14% back to 11, but that's definitely going to normalize back to where it was directionally. It's going to come down. And as that cyclical engine starts to ebb, to me, that again increases the probability of a recession. And that housing and durable goods component is going to come down naturally as a result of the one-time effect waning and as a result of the mortgage rates going from 2.5 to 5. They have every factor that's pointing towards a slowdown in the housing sector. And there's just no way that the housing sector is going to slow down without that pushing aggregate growth lower at a time when growth is already close to zero.
One point on that. So if you look back, I mean, something that I wrote about early 2021 is that the Fed's ultimately going to have a policy error because they're going to be focusing on the unemployment rate, which is very lagging, as you know, probably the most lagging economic indicator. When a lot of people, called 1 million people, left the labor force because their 401k went up crazy, 1 million people started their own job, which distorted the unemployment numbers. Over time, that would help, but they would effectively be not moving fast enough given where the strength of the economy is, which would lead to a policy error because they would have to catch up. We're now in that catch-up phase, and a lot of things you just talked about on the good side of things are leading them to believe that, look, this inflation is effectively unanchored. If you look at CPI right now, of the 8.9%, roughly 6% is from housing, which you mentioned, autos, which you mentioned, and energy, which is sort of a multi-factor type of thing. So of the 8.9, the majority of it is from these three things that by themselves will effectively solve themselves. That was originally the transitory argument, which took too long to solve itself, which they're no longer relying for.
And the transitory argument is like a mathematical thing. If you look at the difference between the U.S. and Europe, it totally explains everything. That's for economists.
Right.
There's no reality in that.
Yeah, 100%. So now effectively what we're doing is we are tightening we are not just tightening, like this is the largest tightening cycle we've really ever witnessed. If you add in specifically the balance sheet, the speed, it's absolutely the largest tightening ever on things that naturally by themselves would probably come down or were one-offs, right? So it's not necessarily like a continued propensity to spend because you have this money. A lot of people have drawn that down, and now we're sort of the level where it's like, all right, we probably spent a little bit too much. It's time to repay our debts, type of thing. So, which is roughly probably three years into your comment
exactly.
before.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion, but who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to him about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd, and I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you a 7-day trial for $1, but because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.